options and futures traders. The markets may be wild, but you don't have to be. Join the Tradier Options Summit sponsored by SIBO on May 22nd. Let's tame the volatility with expert tips and strategies on navigating volatile markets in 2024. I will be hosting this full-day virtual online event. Learn from the best. Industry leaders will share their insights, trade ideas, and strategies on navigating these volatile times. Plus, get a sneak peek into Tradier Futures, which will be launching soon. Sign up now to be part of the action. Reserve your free spot by registering at the link below. If you're part of our email list, stay tuned for your invitation and link to register. Also, remember to visit hub.tradier.com. Join the Tradier Hub for free for all your market insights, trading ideas, market news, and daily live shows with industry experts covering all aspects of the financial world. See you on the 22nd at 10 a.m. Eastern Time sharp.
Hello and welcome to Options Guy TV. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host here for about the next 25 minutes or so. Today's date is Monday, May 13th. The markets are open, and we're going to be looking at a couple of strategies that we've been toying with around earnings. We're looking at a play that we did in NVIDIA. They're going to be announcing on the 22nd, which is a Wednesday. Everybody's been waiting for this big earnings announcement, and by far the most talked about company by all of the other major mega cap tech stocks. And if you mention NVIDIA, well, you're in your earnings report, and saying you're buying chips usually has a good thing. Some people get a little bit nervous because they think they're going to be spending too much money, but all the well-capitalized companies are trying to take advantage of AI and throwing some money at it, to be blunt. Meta actually is the one Magnificent Seven stock that had a really good earnings report, but mentioned how much they are going to spend developing AI, and that actually drove the stock lower. A lot of other companies have had fairly strong earnings, and well, I should say relative. They're not really holding up as much. Google had a real strong showing. Still, we had Microsoft and Amazon all strong showing so far. Apple has had a little bit of a bounce recently in their underlying stock after their earnings. So today we're going to start getting into retail earnings and learning about how these companies are going to be spending in AI, because they will be talking about it. The biggest one is Home Depot. Home Depot is going to be announcing tomorrow before the open. So we're going to look at a fancy trade in Home Depot. We looked at an inverse skip strike butterfly, looking for volatility in NVIDIA. And that was a trade that we focused on last week. And that's a couple of week trade heading into earnings. We want to be out of it before earnings, probably this week. I'm not seeing a lot of movement in NVIDIA. Its stock is still just hanging right where it was at when we first put the trade on. It's gone up, gone down, but today it's actually sitting almost exactly where we put the trade on, which is not a good scenario for the strategy that we chose. We're going to actually look in Home Depot at a Christmas tree butterfly. We're going to look at be a little bit bullish. We tried a butterfly not that long ago in Disney and around Disney's earnings. I don't really want the risk of doing a skip strike on the upside, but I'm also a little nervous about how the market might react to any comments about spending on AI. Also have Walmart. I feel like they will have some comments too. These are both well-funded companies that got a lot of cash in the bank, and I do expect them to exert their dominance in the marketplace, and the ability to spend on these things is just going to make their dominance even better. Also have Under Armour that's going to be announcing this week. They're announcing on Thursday, also before the close, and Applied Materials. They're going to be on Thursday after the close. So let's start by looking at our trade that we're going to do in Home Depot. And let's open up the options playbook. And inside the playbook, and let's zoom it out one more. Yeah, that looks pretty good. So in this instance, what we're looking to do is, this is actually called a Christmas tree butterfly with calls, and I'm not quite sure why. It's a leaning Christmas tree. Never did ever figure out why they came up with this name, but here's the setup. We're going to buy a call at strike A and then skip over strike B. So the long call spread, it gives you a wider range. And then we're going to actually sell 3 calls at strike C and then buy 2 calls at strike D. Now, this will be a little bit cheaper than a regular butterfly, and it'll give you this nice landing area if you are correct on the forecast on Home Depot. Now, the downside of it is that you lose sooner, in that this is a very short call spread that is helping to pay for the long call spread. So it's going to be cheap. It'll be around 30 cents or so when we get it all set up. And I just think once again, I'd like to explore different strategies around earnings. You get an answer right away because they get the earnings announcement, and then you see what happens with the pricing on the stock. Butterflies are always good if you're correct on your forecast, because they want implied volatility to come in while you put on the trade. Now, here's the benefit of doing a Christmas tree butterfly is this strike is much further away than that strike, right? Because you got this nice long wing, I guess would be the word that we would use on the Christmas tree butterfly. And if I'm looking at this, what you really want is, if we hit strike A, you want strike C to start withering away. And we're far enough, and it's in a fairly expensive stock, that's why I'm enticed by this strategy. I wouldn't mind doing a skip strike in Home Depot, but they're announcing on Tuesday. And I think it's too short. If you are correct on the forecast and the market starts coming up towards your strike A on the upside, if that happens, we just have so many days that you'd be nervous that it might actually go all the way through and hurt your position, even though you were correct on your forecast. I'd rather them be announcing on a Thursday and have 2 days for that trade to live. That's just the dynamics of option pricing, as far as especially underlying stocks that are around earnings that have pumped up implied volatility. So this is my first time. We're going through a lot of the different strategies that we have here in the options playbook, and I'll just pull up in a separate tab. We'll look at all the strategies. But if you expand all of these are everything that we have. And I always like to look for scenarios where I can talk about some of the veteran plays and get into some of the seasoned veteran plays. And then we go all the way down to where we're actually talking about the upper echelon type trades. Here's where the skip strike butterfly is. We have it in a seasoned veteran, and that's where we have it located right now. But as you get further in, then we're talking about all stars. And this is stuff where you have a lot of naked risk, unlimited risk to the downside, like a short straddle and a short call or a short put. That's where those strategies come in. So this is going to be our trade for the day. It's going to be the paper trade right around earnings on Home Depot. And then we'll also look at the opposite side. And I think we're going to go on the call side of things. We've been doing long call spreads every Monday. And by looking at the chart and everything, I think it's time to go back to the skip strike butterfly. We're getting to the high end of the range. And I guess now that I'm here, before I go there, let's pull that up. Kind of a tangent here. Apologize for that. But I think what we'll do then is we'll look at that skip strike butterfly right here with calls. We're going to stay bullish on the marketplace, but my concern now is that we've had too much of a run up. We're too far extended, too many days in a row where we've just had solid moves in the SPX to the upside, which has been great for the strategies that we've been doing. Had a little bit of a breakout. I'm going to highlight that in the chart. But now we're getting close to that all-time high. As a matter of fact, the all-time high that we have is 5264.85, 5,264.85, and we're getting close to that range. So I think it's going to be hard to break out to that to the upside. So we're going to look at a skip strike butterfly kind of centered around that number, because if we get to that number, we'd like it to kind of just stay and hang out. So that's the strategy that we're going to look at. Now we can back out, and let's go and take a peek at, and let me tab over to the TradeHawk software and pull that up. All right, there we have it. So here's Home Depot. Home Depot is a $345 stock, so it's a real stock, real values. And I prefer to trade in, when you're looking at options, I like to trade in higher price stocks. I used to love when we had Amazon around $1,000 before they did their big split. And the biggest thing is that you can get wide on these, and then you got different dynamics. You can get wide on the 355 to 365. That's 10 points. I wouldn't even mind being 15 points wide, but I just don't want to spend that capital, because if the market does go down, we're going to actually lose our net debit that we paid for this trade. It's limited and known risk, like you saw in the profit and loss graph inside the playbook. But with that said, I like the fact that we can get wide on this one, and then we're kind of short here on the risk side of the butterfly. We announced Tuesday, so we have all day Tuesday, all day Wednesday, all day Thursday, all day Friday. That's a fairly long range. We're looking at about a 50% implied volatility. If we look at the most at the money option contracts, you're talking about $15. So if you buy this one and buy this one, we'll call it $15. That's what the expected move would be. That would put you right at 360 if it went up. So 345 plus $15 is 360. The one standard deviation move is right on the strike that we sold, and it's showing about a 15 delta here. Obviously, the TradeHawk software has this real nice feature where you can actually highlight the strike that's closest to a one standard deviation move, and that's this 365 strike. So it's feasible to get there. They're saying the expected move is 360 or up to around 360 after earnings. Now remember, when we talk about standard deviations and expected move, we're never actually looking at a direction. We're just saying that's the over under, that's the line in the sand. And also, a lot of times the pundits or the people that will mention it on a lot of the financial shows just talk about it as after earnings, but that's not really true. If you're using these prices are the expiration date on the 17th. So that's the move by that date. That's the expected move. So other things, like if they do announce on a Thursday, you're a little bit more accurate to by using the numbers, by just looking at the quotes of the option contracts, so that kind of helps out too when you're setting up your strategies and looking at things. There's a little bit more fluff in the numbers if they're announcing on Thursday when you got that Friday expiration. Okay, so here is the trade all set up, and this is the difference. Now, if I'm looking to do this trade, you got to add one here. And we say a 1x3x2. What's important is that if you buy this one and you pay for the wings, this is your protection, the 355 and 370 trade. If you look at this, you have to have the green spread numbers, the buys, actually add up to the middle, which is the ones that you are selling. So in this instance, we're looking at paying $1 for the potential to make $10 on our trade from 355 to 365. And then if we send this trade to the what if calculator, we'll look at what our Christmas tree looks like, which I guess the floor has decided what a Christmas tree should look like. So we're check that out, and we'll zoom in a little bit here. One more time. Dang it. So here's where the underlying stock is at, 345. Here's where the expected move is at, somewhere right around in this range. This is what the profit and loss graph looks like right now. If we get earnings and implied volatility comes down, this will slowly morph into this range. Now, If it opens all the way up to this strike right at 365, we should be decent on the trade. We won't have a home run until we get a little bit more time decay in the option contracts. But if I'm anywhere in this range after earnings, like say 10 a.m. tomorrow after they announce, I just want to get out of the trade because I don't want this risk. I don't want to get into this range on the underlying stock. So if I'm up a few cents, I'm going to get out. If I'm up $1, I'm going to get out. It's hard to say exactly how much you might be up. Once again, I like this trade because you have this long this long wing of the butterfly, and what you really need to happen is this to pick up momentum. Well, these 3 option contracts are decaying, and that's a battle with this trade. So that's our official paper trade for our earnings play this week, which is going to be in Home Depot. We're looking to buy the 355 strike call, sell 3 of the 365 strike calls, and buy 2 of the 370 strike calls, all with the May 17th expiration date. Limit price, we'll say 103. It looks like it's moved a little bit. We'll make it 105. Make the math simple. Try to fill that at 105. That would be a good fill. Be close to a midpoint fill on this butterfly going into that trade. Max risk will be that $105 for every 1x3x2 butterfly that you put on. Max upside, we're not really looking to make the maximum. You're talking about 10 points, the difference between this strike and this strike. But if I can get out and I put it on for $1 and I can get out for $2, I'm going to consider it. If it's trading anywhere north of that, I'm willing to get out of this trade, especially depending on the day towards that expiration date that we put this trade on. So that's the first paper trade. Now we're going to go back to the SPX. We haven't done a skip strike butterfly in the SPX in a while. And like I said, with the market 52.64, 52.65. Okay, so right here they're saying this is the May 17th expiration, 4 days away, and we're in the W's. Okay, so first of all, this is the 3rd Friday of the month in the SPX. So you see you have 2 May 17th expiration dates. The SPX, this is the old time SPX, and that used to be it is still European style options. You want to have the W. The W used to stand for weeklies, which now really aren't weeklies anymore because they have a lot of different expirations that go out more than a week, but they still use that W as a factor here. But these trade all day on Friday, where these ones don't. These do the settlement Friday morning. And I just don't want to be in those option contracts. I want to trade these. So there's one time of the month, the 3rd Friday of the month, it gets very confusing in the SPX because they have these 2 different option contracts. And they used to have index, and I wish they'd just keep the chain rolling, where if you typed in SPX AM or SPX PM, that dealt with the settlement, and they would give you that entire chain. And they've decided to stop doing that and confuse everybody by putting them all in the same under the SPX symbol, all of them. So that was the Chicago Board Option Exchange. That was their decision. All right, so this is about where that's at. We got the SPX here. Let's see where the 1 standard deviation move is at. So 165 is here. We're looking at a delta of about 32 on that. So a good probability of getting there. And 53.05 is where the 1 standard deviation move is at. So I think we're going to go here. We're going to try to do something around this underlying. And you know what, I'm going to change my mind here. I'm going to go a little bit closer to the expiration date. We're going to go 1 day closer. Now, it affects your ability to adjust the trade. But since we're kind of focused around that all-time high, I don't mind losing a day in the S&P 500 index to put this trade together. So we're going to go to the May 16th expiration. Let's change this up. look at where that one standard deviation move is at, right around the 5,300. And we got the 65. So let's buy the 65. We'll go 10 points higher to the 75. Maybe let's do 15 this time around, and we'll sell this one. Add a little bit more of a margin requirement by doing this. So now we're going to go up 30, and we're going to buy the 5310s here. And we're looking to get this done. Now, this is the skip strike. This isn't the Christmas tree. Totally different. We're skipping a strike. We're embedding a short spread to pay for a butterfly. And then in this instance, we're looking at a net credit of $1 to the account, $1.10 right now. We'll keep it at 115. That's where I think I would try to work this at. And we're going to add $1,500 worth of requirement to the trade. Now, it's the same scenario. On Options Guide TV, a lot of times I'll do 10-point wide strikes. But the problem with that is that you need this option contract to go away. And on the show, we just kind of want to manage the risk on some of the trades that we're looking at. I like to go wider, but the risk is if we blow away the numbers, or if this week, we do have a lot of economic data that's coming out starting tomorrow. So there is going to be some volatility in the marketplace. You're going to hear a lot on the retail side of things. The retailers have been, the consumer has been really keeping this market afloat. Even though we've had inflation, we still have seen a strong consumer, mainly because of jobs and wages. All right. So I'm okay with going 15 points wide, and mainly because of things that we're talking about. There's a lot of headwinds to break out to the upside. We went one day shorter. We're not doing the Friday expiration. We're going to do the Thursday expiration. We have the all-time high right here at 52.65. We got 15 points in that range, all the way down to here. So yeah, I like this trade this week. We still got a strong bullish market, but the market does kind of want to give back. I feel like it needs to. We've had just too many up days in a row. A small little down day in the middle of the charts, and we'll look at that before the end of the show. Now, if you have any comments, because I'm going to give you the final read back here of our SPX skip strike butterfly. But if you have any comments or questions, please put them in the chat box. If you're on the Tradier YouTube channel, you can do that. We're also streaming live on x.com right now, and also inside the Tradier Hub. If you want to see all the great speakers, just Google Tradier Hub, and you will, with one little sign in, you'll have access to all of the programming that Tradier is sponsoring inside the hub. All right. 115 here. And there is an answer. All right. Yeah, I could. We do have one question that has popped up, but let me give this read back. That's all right. We'll do it right now, I guess. Hello, Brian. You answered my question last Friday. Could you do another 0 DTE trade on SPX on this coming Friday? Well, we would look at Friday, right? Now, you can do it in the SPX because you do actually have expirations every single day of the week. But I'm getting a little bit long in the tooth. We only got 5 minutes here before we're officially done with Options Guide TV. But yeah, I don't mind that. So on Friday, we actually did look at a very short-term trade where I sold a short put spread, and I did like that side of the trade better. And we actually bought a long call spread with the net credit. We tried to get that all done for even, and we did do that on Friday. And the trade just expired worthless across the board, lost nothing besides commissions. At one point in time, I think it was trading for a nickel. I would have tried to get it done for even, which is 0 on the account. But yeah, we can do that. We'll look into that at the end of the week. Let's focus on this trade. I like this trade this week. And we haven't done a skip strike in a little bit. And the fact that we're going a little closer, we have a lot of headwinds to try to break out to the upside, but we have the potential. If the market goes down, we're still bringing in a buck. We have a $1,500 requirement to put this trade on. So every 1 by 2 by 1 skip strike that you put on, you're going to have $1,500 in requirement. So here's the readback. We are in the May 16th expiration date. We're looking at buying 1 of the 5265 calls, selling 2 of the 5280s, and buying 1 of the 5310s. We're going to do this for a net credit of 115 to the account. That was a nice price, but it's already moved on us, so we're 105 now. Now we're 115. I'd leave it in 115, and I've seen that number pop up quite a bit. See if we can fill close to that midpoint on that trade. And then let's send this one to the what if calculator and take a quick peek at that risk that I'm mentioning. Pull this down and go this way. All right. So when we first put on the trade, here we're net zero. This is the 0 line. And to start with, we're going to have a lot of risk on the upside. If we actually hit our short strike here, we're going to be down about $400 on this trade. And then our maximum risk down here is, well, minus the net credit received. We got a net credit of 115. So you're talking about 1,500, but we're bringing in a decent credit of $1.15 on the trade. So the total cost, and you got to look over here on the right-hand side, right? This is where it's at. Total risk is $1,385. We do not want to get there. If it ever comes close to this, we want to close it out. I don't want to get in this range and have that danger of our short spread hurting us badly. It'll hurt enough as it is, but we don't want it to hurt us badly. Okay, so let's move this forward. We're on Monday. Thursday's that expiration. Here's what it looks like on Wednesday. So now if we're going up a little bit, we're starting to make money. And then this is what it looks like on Thursday. And then as the expiration or as the end of the market, so we're talking about, let's say 3 o'clock, right? So we're looking at, in Army time, we're going to be, all right, on the 16th. Now you see eventually as expiration comes in, this is going to morph into that expiration date a half hour before the close on this trade. And then as we go up, we slide all the way up, still have that risk. So ideally, we'd be somewhere right around here with a day to go, right? We don't want to be in this range. We'd like to be right here. And hopefully the market starts creeping up. And if it doesn't, that's all right. We're going to make $1.15 on the downside if it goes this direction. Like this trade this week. Happy to show that. And let's hope it works out. Let's hope this one works out. That's it for this edition of Options Guide TV. Please sign up for the big event with the CBOE that Tradier is setting up together, the Options Summit. And then also click subscribe, ring the bell if you're on the Tradier YouTube page to make sure you get all the alerts. And we'll see you this Wednesday. See how our Home Depot trade did. We didn't look at our NVIDIA trade, but it hasn't moved much. Like I said, it's 900, which is blowing my mind that the stock just keeps coming back to that level. We'll look at that on Wednesday too, see where that is at, see if we want to get out of it. We should be about even or a little bit down on that trade. And then we'll also see if we need to make an adjustment in this skip strike butterfly. Thanks for coming by, and we'll see you this Wednesday, 11 a.m. Eastern time for the next edition of Options Guide TV.
Calling all options and futures traders. The markets may be wild, but you don't have to be. Join the Tradier Options Summit sponsored by SIBO on May 22nd. Let's tame the volatility with expert tips and strategies on navigating volatile markets in 2024. I will be hosting this full-day virtual online event. Learn from the best. Industry leaders will share their insights, trade ideas, and strategies on navigating these volatile times. Plus, get a sneak peek into Tradier Futures, which will be launching soon. Sign up now to be part of the action. Reserve your free spot by registering at the link below. If you're a part of our email list, stay tuned for your invitation and link to register. Also, remember to visit hub.tradier.com. Join the Tradier Hub for free for all your market insights, trading ideas, market news, and daily live shows with industry experts covering all aspects of the financial world. See you on the 22nd at 10 a.m. Eastern Time, sharp.
All opinions expressed by Tradier Hub contributors are solely the contributors' opinions and do not reflect the opinions of Tradier nor its affiliates and or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Tradier nor its affiliates and or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual live trades or positions. Such information is not intended to be financial or investment advice. Tradier Inc. is the parent company of Tradier Brokerage Inc. Tradier Brokerage Inc. and Tradier Inc. are separate entities with their own products and services. Securities products and services are offered through Tradier Brokerage Inc. Tradier Brokerage Inc. is an independent subsidiary of Tradier Inc., all rights reserved, member FINRA SIPC.